Anyways, let's jump right into the real estate tax planning, some of the tax traps, and what I call the MOs, the missed opportunities. And there's a lot of these with real estate. I mean, real estate is a hugely successful investment from a tax perspective. So that if you're going to go out there and you're going to make a good investment in the stock market, going to make a good investment in real estate, the real estate investments have the tax benefits associated with it while you own the asset. And that's really huge because you're going to get benefits all along if you do proper planning. And so, one of my thoughts always with real estate is I look at it from a 3 point perspective. And that is, what am I going to do with this property before I buy it, while I operate it, and then when I sell it? And for some of us, those could be a very short period of time because you could be flipping properties. But for other of us, myself included, where I do long-term residential rentals, I may be buying and holding for 15, 20, 30 years before I even consider selling or what the effects would be if I did sell. So, with that, I think we have to know where are our tax traps with real estate. How is the tax code going to grab us here and maybe not allow us to fully gain all of the tax deductions that you may be entitled to? So I'm going to talk about each of these different points here as we go along. But the passive activity loss rules are real important. And they're real important to understand because they hit people at an income starting at $100,000. And several years ago, when $100,000 was a whole lot of money, a lot of my real estate clients, at least going back, let's say to the 2000 or 2001 or something, 20 some years ago, we didn't have to worry about the passive activity loss rules for some of my clients because they weren't anywhere near 100,000 of income. And now that's a pretty common amount. Certainly, you don't consider somebody or a family that makes $100,000 a year in the United States to be a real wealthy family necessarily. So we're going to talk about the passive activity loss rules while you hold the property, and then what happens when you sell the property. I mentioned the flippers here, so those are called real estate dealers, and we'll talk a little bit about those types of taxpayers as well. And then also investing in an IRA. Can you do it? Should you do it? Who should do it? So let's look at some of those benefits as far as who should be doing these investments, and also in the context of the tax traps. And as far as the missed opportunities go, a lot of people don't understand depreciation. And this is where, in my opinion, depreciation and this little QBI guy down here on bullet point 5, I guess it is, are the two really big things that people don't understand when they're holding rental properties and looking to maximize the tax benefits. So let's look at some of the depreciation and some of the other common deductions along with these repairs versus improvements. We'll talk about that as well, along with the Augusta rule and also the personal residence rule. So that's what I'm going to look at tonight as far as some of the things that I want everybody to consider when we're looking at rental properties with taxes. Now, the first thing I want to suggest to you is we do not want to have taxes drive our decision about the rental properties. Okay, just like we don't want taxes to drive any investment decision. You need to make sure that you have a good investment. So you need to do your own due diligence and see, is this rental property going to be a quote unquote a good investment? Then and only then should we look at what are the tax ramifications. And in real estate, a lot of times that can make a good investment really, really good, because not only can we be making money on this, but we could be at the same time recognizing a tax loss. So with proper planning, I really like the real estate realm. I really like the fact that there's a lot of rules that we can look at and plan as far as what we're trying to do with our personal situation. So our pals here. So passive activity loss, PAL. When you hear PAL, just remember it's probably not your pal, but it's a way that rental property losses can be or maybe not be claimed against other income. So our first rule here, and this is for all rental properties, is that it's a passive activity. And that means that if you have a loss here, it's only permitted against other passive income, but cannot offset active income. So, what does this slide mean here? Well, what it really says here is that let's say I make $100,000 a year at my W 2 job and I lose $5,000 a year on one of my rental properties. What does that mean? Well, it means that in this particular slide, I can't deduct that $5,000 against my $100,000 of active income. So the first rule then, when we look at trap number one, is when you don't like a rule, a tax rule, or when you don't like the advice that your tax advisor is giving you. So in this case, I just said, hey, you can't deduct that. You need to say at that point, how can I? How do I need to be structured to be able to claim this loss? Is there an exception to this rule? Okay, so is there an exception to trap number one? And it turns out that the answer is yes, there is an exception. So what is that exception? Well, it's the $25,000 exception. And so if you fit into this, what happens here is that if your AGI, and this guy is adjusted gross income, AGI, adjusted gross income, is less than $100,000, the last slide doesn't apply. And what that means is that you can deduct losses. So let's say my adjusted gross income this year was 95,000. That means that I can deduct up to $25,000 of losses against my 95,000 of active income. Okay, so this is a really nice rule if we're making less than this $100,000 a year, or if we're having losses that are less than this 25,000. Because in this case, let's say I had 50,000 of losses in rental properties, and again, my AGI was under this 100,000, I could deduct 25,000, but anything over that gets carried forward. So this is a good rule. We like this, except for this last bullet point, complete phase out at 150,000. So what does this mean here? Well, it means for every $2 of income over 100,000, I lose $1 of this 25,000. So if my income for the year is $100,002, I can deduct 24,999. And once you go with that 2-to-1 ratio, when you go up 50,000 from 100 to 150, you completely lose the $25,000 exception. So now what if we're dealing with a client, taxpayer, this may be you, where your adjusted gross income is over 150. So let's say it's 200,000 for the year. So now you come to me and you say, okay, I know the first slide doesn't apply and the second slide doesn't apply because my income is more than that. So that means I just lose out. I can't deduct my losses because of this fourth bullet point here that says complete phase out. And the answer is no, there's an exception to the exception. And that's our real estate pro exception. And this is absolutely key to understand this, because what we've done here is we replaced 25,000 with unlimited. So this loss could be as high as possible. Okay, whatever it is, it is. And I'll show you how we're going to get some of these losses that can be pretty high with some of the depreciation deductions that we can claim. But here's the rule on the real estate professional, because this is such a major tax benefit that the IRS has a test, obviously, like everything else with the IRS, right? There's a test on this to see if you qualify. But this is a really key point in this situation. If you file a married filing joint return, if either spouse qualifies, they both qualify. And so I have situations in the past where, let's say, I'll use an example of I had a few members of the Denver Broncos football team. And so in this case, the husband was making seven figures, right? Way over 150,000 a year. So there's no way that they qualify for that 25,000 exception because the husband is making a multi-million dollar contract, right? So he's making a lot of money. But now what if the wife qualifies as a real estate pro? Now all of those losses that they may have, and again, we'll see how you may accumulate them, the losses then can all go to offset the income of the football player or the person that's getting the W-2 or the active income. So this is a really key point, that maybe between the spouses, one person works in a field that has nothing to do with real estate, so they'll never qualify. So what we try to do there is look at, can we get the spouse that maybe not working at all, or maybe he or she is working part-time, to qualify as a real estate pro? And there's three rules here to be a real estate professional, with this yellow highlighted part, this and here, meaning that it's 1, 2, and 3. So you satisfy only two of them, you don't qualify. Number one is more than half of your time that's spent on business activities is spent on real estate. And so somebody like me, let's say when I'm a full-time attorney working, and you say, well, okay, that's 50 weeks, 40 hours. Kind of wish it was only 40 hours a week, but let's say that was 2,000 hours a year. I would have had to work 2,001 hours or more on real estate to be able to qualify if I was working full time in, let's say, this legal field that was not real estate related. So number one is you've got to get over this 50% rule. And number two is you've got to get over 750 hours. Okay, so it's about 15 hours a week on that. And you must materially participate. So you must make decisions about the rental activities. This is critical. And I've done entire webinars on real estate pros. And I'm fairly confident if you dig into Don's vault here on Protect Wealth, that you also find some real estate professional stuff. But if this may apply to you, if it may just a little bit, you'd say, well, I might be able to squeeze this in. If you've got one spouse making a lot of money and the other spouse not working a lot, if you can qualify that other spouse as a real estate pro, we now get to deduct all of our losses. So understand these passive activity loss rules, because it sounds complicated, but it really isn't. There's the $100,000. If you make more than that, there's the potential $25,000. If you make more than 150, it's unlimited only if you qualify as a real estate professional. Okay, you have to satisfy all three of these rules on this slide. All right, I want to shift gears a little bit to selling the property. And this is trap number two, is that we don't understand capital gains, and that we don't understand the tax impact until it's too late, until we've already sold it. So number one is, what's our holding period? In other words, you look at your settlement statement on the purchase, what was that date, and figure out how long have you held it. We want to get to the 1 year and 1 day period. And that means that it's going to be a long-term capital gain. So if we're flipping properties and we're a real estate dealer, this slide is out. So if you're a real estate dealer, you get no capital gains at all for a dealer. Okay? And so obviously we're not liking that too much. And so if you're a dealer, we've got other rules and other structures that we can put in place to minimize the impact of this, and also not have your dealer status impact maybe some long-term rental properties that you're holding for appreciation. So before you do anything with the property, I always want to know what your plan is. Before you even buy the property, it's like, how long you plan on holding it? And I get it that the plans change all the time. And, you may plan on selling a property and then find out it's a great investment that's, cash flowing positive $1,000 a month or something. And why get rid of it, right? So you have to look at the planning at the beginning too, but also before you sell it. So once we know what our holding period is, and let's say that we're already over a year and a day, so we've held it a few years or 5 years or whatever, we've got to figure out then, what is the amount of capital gain and how much tax are we going to pay? And this needs to be estimated at the beginning, not at the end. Okay, so you don't do this after you make the sale. And you're going to be looking at the long-term capital gains rates. And so we have to look at what is our taxable income here. And this is not a typo with this 0% rate. So you can see here that, if you're making up to 47 grand, you can double that if you're married filing a joint return. So you're making $94,000 or less per year. You may have a 0% rate on some of your capital gains on stock sales or real estate sales or whatever. And the 15% rate you can see for using a married couple here over at the edge. I mean, you have to get to almost $600,000 a year before you get into the high 20% rate. So, looking at this, you have to understand what your tax hit is going to be. And if you take a look at your purchase of the property, your HUD-1 or settlement statement or whatever you have, and then you add in all of the improvements or whatever that you have that are going to add to your basis, subtract what you think you're going to get for a sales price and plug it into this. Are you happy with paying 15%? Okay, plus whatever it is to the state if you live in a state that taxes this. Maybe you are, maybe you aren't. But you've got to know about this before you sell it, because you may want to do a 1031 exchange, or you may want to do an installment sale or some other type of sale that could minimize the current tax implications of it. So we need to understand what our approximate gain is, plug that into this little bracket here to figure out, are you at the 0, 15, or 20%? And then let's not forget about the Obamacare, what they call the NIT, the NIIT, the 3.8% net investment income tax. This is a major problem here for us because the amounts have not been indexed for inflation. Meaning what? That this 250,000 and the single at 200,000, these were the way that the law was written 15, or was it 12, 15 years ago, and they've never indexed them. So it's possible that 15% rate could be 18.8%. And it's certain that if you're in the 20%, you're going to get hit with this 3.8% tax. So don't forget about that as well when you're computing your tax hit. So there's clients that I've had. Let's say, I'll use the obvious California example. I know everybody, California hates to go, oh yeah, they're going to talk about the high taxes again, but this can happen with, you're making a quote unquote a lot of money, and you get hit with the 20% capital gain, you get hit with the 3.8% tax, plus a 13% tax in California, and you can very easily be into the mid 30s before you know it. So understand what your tax obligation is going to be, so that if you don't like it, that you may look at ways that you can get around it. All right. Other things as far as the trap number two with the capital gains is that we don't look enough at the avoidance. And notice here that this is not tax evasion, this is tax avoidance, right? Avoidance, legal evasion, 3 years in prison or whatever. But there's lots of ways that we can get around the capital gains if we don't want to pay the tax. Now, for some of us, we may say, well, we're in a low tax bracket this year. We're in the 15% capital gain. It may not be a bad idea to just pay the tax and have the money at that point rather than deferring it out to the future. But I really love these 1031 like-kind exchanges. This is something that you need to plan for, but I really like the opportunity there to defer. And with estate planning, you can then eliminate all of the capital gains. I also like the installment sales as far as, well, we may not want to do a full like-kind exchange. We may want to just carry the note here. And then we can decide based on the amount of the installment payments, how much is going to be reportable in each year that we receive these payments. We could have done the transaction in an IRA, which obviously would have at least eliminated some of the taxes right up front, perhaps. And rental properties we'll talk about here, and then the personal residence rule as well, that there's a lot of folks I've seen that have rental properties that they convert to their personal residence and then use the exclusion. So let's look at a few of these just real quick here as far as what I was talking about here. There's entire webinars on the 1031 exchange process. This is something that every real estate investor needs to understand before they sell a property. So if you just bought your first rental property or you're thinking about buying your first one, this slide doesn't apply to you until you decide you're going to sell. And this is the time that you need to understand that this 1031 exchange process, this animal out here, is available to you if you want to use it. So if you want to do that, everything comes into play before you're selling your property. Notice that's step number 3. Number 1, you have to find somebody to handle it. Very easy to do. List it for sale, sell it. And then you have this QI person over here ends up handling all of the money up here. So you want to make sure, obviously, that person or company is bonded and well respected. So because they're going to be handling your money, and then they'll be at the closing again when you find your property that you're replacing your old property with. So this is a perfect opportunity for somebody that wants to stay in real estate and not recognize the capital gains. But sometimes we just want to get out of real estate. And so at that point, then obviously this isn't going to help you because you're going into at least one more replacement property. And at that point, then you're going to need to look at the installment sales, or what is the effect if you take the whole capital gain in 1 year. Okay, I mentioned these real estate dealers, and the real estate dealers are the flippers. Okay, these are people that are buying property, buying real estate, and using it as inventory, just like you would, down at the corner store with, a 6 pack of Coke or something. And so what you're looking for with the corner store is I want to sell as many 6 packs of Cokes as I can, right? So I want to turn my inventory over and over and over. And the more times I do it, the more profit I make. Same thing with a real estate dealer. So instead of the Cokes, we've got real estate, we've got rental properties. And so there's a facts and circumstances test, because the problem, and I'll show you in a sec here, is that this is not a good designation from a tax perspective. So unlike real estate pros, which is we really want to qualify as a real estate pro, we really don't want to qualify as a real estate dealer. And so what they look at to determine are you a dealer is, well, how many sales are you doing during the year? How long are you holding them? So you're holding these properties a month or two? You holding them weeks, days, years? What's your holding period? Profits received? How much time and effort you're spending on the sales? Is this your main job? Is this your main business type of thing? So how much time are you spending here versus other jobs? And what are you doing as far as improvements? Are you attempting to rent it or sell it? So, there's situations where you may end up buying a rental property and selling it right away and not being a dealer. Let's look at a situation where, let's say I buy a rental property today. It's in good shape. And so I do some cosmetic repairs, paint, whatever, list it right away for rent, and nobody rents it. And I do that for this month, next month, the following month. It's like, man, I don't know what the rental market is, but I can't get anybody to rent this thing. And then you sell it. Simply because your holding period was really short doesn't mean that you're a real estate dealer, because your intent there was to rent it, right? To keep it as a rental property. It just didn't work out. Or maybe you decide you're going to rent this property out that you paid 300,000 for, and I come along tomorrow and say, "Hey, I'll give you 400,000 for it, cash right up front." And you're thinking, "I had no intention of selling this, but I can pick up $100,000 cash with no risk. Of course I'm going to do that." So just simply because the holding period is short or the profits you received are large doesn't mean you're a dealer. But if you're buying a property today, you improve it tomorrow, and then you list it for sale the next day, and you do that a bunch of times during the year, and then you tell the IRS, "Well, I wasn't really trying to flip properties," your actions say, "Yes, you were." So what happens? So you're a real estate dealer. Big deal. What's the problem? Well, number one is, all of your profits are subject to self-employment tax. Oh my God, that's 15.3% on top of the capital gains or the income tax or this. Oh my. So you can see that this is going to be a major problem. If you do an installment sale, so you do an owner carry where you're carrying the note, so you're the seller of the property and you're the bank in the property, you have to report all the income up front. The gains are ordinary income. So even if you happen to, you're trying to flip a property, but you hold it for 13 months, it's not a long-term capital gain. And you can't do like-kind exchanges because it's inventory. Okay, it's not an asset that you're holding for investment. So you can see that there's a lot of problems here with being a real estate dealer. And if you fall into this, and I've had multiple clients that have been real estate dealers, that's what they did for a living. They flip properties. There's nothing wrong with it. There's nothing illegal about it. It's just that we need to plan for it. And so typically we'll throw all of their dealer activity into one entity and all of their rental activity into one or more other entities. So we don't combine a long-term rental with flipping because we could then subject the long-term rental to all of these negative tax ramifications. So again, structuring, we can get around some of this, looking at potentially a C Corp as a real estate dealer is a typical type of situation that I strongly would encourage most people to look at, not having this hit their personal tax return. Um, and sometimes, if you're going to be doing some dealer activity, maybe a little bit of it, you may want to look at doing this in an IRA. Now, I put this here, bullet point number 2. It's a good strategy for flipping, but you may have this UBTI or UBIT or what, I mean, people call it a few different things, but it's unrelated business taxable income. And this applies to nonprofits. This applies to IRAs, 401ks, SEPs, simples, whatever. And so when I hear somebody say, I'm going to do all of my real estate investing in an IRA, my first thought to them would be, let's step back a second. And I'm not saying you shouldn't have any real estate in an IRA, but what I am suggesting here is step back and say, what would be the tax implications if I do this in a currently taxable account? So let's say I'm going to buy a piece of real estate, rental property here. It's all ready to go, and I have the money in my IRA or I have the money available in a taxable account. I can now look at both of those and say, all right, if I buy this property for 250,000 and I pay cash for it either way, what are the ramifications of it? And so maybe we want to be able to do some real estate investing to diversify our retirement portfolio. And that's perfectly fine. But a lot of times what comes into play is this UBTI, this UBIT. And this stuff it can make things quite complicated when you look at some of the investments in an IRA. So if you're going to do investing in real estate in an IRA, we want to make sure that you understand this issue. Okay, this is the big issue, and you have to understand it because it can subject your IRA that you thought was going to be tax-free to some very high tax rates. Not you, but the IRA. So if we take a look at the next slide, and I'll go back to that last one in a second, but the UBTI can apply if, and so this is real estate. There's only 2 ways that it's going to apply. Number 1, you use financing. So if you're using financing within an IRA, then some of the gains that would be, I guess, applied to the financed portion of the capital gains could be taxable. So when people will say to you, do the rental property in your IRA and you'll never have to pay tax, like, wait a second, that may be true, but it may also not be true. So if you're going to finance stuff, if you're going to use leverage in your IRA with real estate, you may have UBIT. And we need to have some tax strategies to make sure that your IRA is not going to owe taxes. And the second part is not necessarily dealing with the financing, but dealing with the dealers. So one thought on the flippers, right, is, well, do everything in the IRA and you won't have to pay any tax. Well, if you're running a business within your IRA, which a dealer is, remember, a dealer is not an investor. A dealer is a business person. It would be just like running any other business, running my law practice in my IRA so I don't have to pay taxes. No, you can't do. I mean, you can do it, but you'll be paying UBIT. The other problem with it, beside this UBIT, and again, make sure you get educated on this before you get into real estate in an IRA, is these self-dealing issues, these prohibited transactions, where if you get a present day benefit out of using the IRA or the IRA's investment, it's probably going to be self-dealing. And if you do self-dealing, you've now broken down the IRA and everything is going to become taxable. So when I've seen people get into this and they start, maybe they put some extra money in for some of the repairs, or they're using related parties in some of the transactions. They do things that may seem totally logical, may seem totally rational, and it may be a good investment, a good deal for the IRA in this case. But if it's a prohibited transaction, it's a prohibited transaction. So if you're dealing with disqualified persons, okay, so that would be myself and my spouse, and then I go up the food chain with parents and grandchildren, and down the food chain with kids and grandkids and great grandkids and whatever. And then you're looking at any entities or trusts that you own at least 50% of, okay, or any combo here. So you may be in a situation, let's say I'm in a situation where I have a rental property and I'm going to sell it. And let's just say that a normal commission would have been, 3% for the seller, let's say. But one of my kids is a real estate broker, and she says, I'll do it for 1%. That is a prohibited transaction, even though it's a benefit to the IRA in the sense that it's only paying a 1% commission instead of a 3% commission. So again, don't think necessarily logic. Think, if you're a disqualified person, you can't do anything with this IRA. Now, you can also look at the flip side of that and look at, okay, well, who's not disqualified then, right? Well, yeah, you can look at brothers and sisters, nieces and nephews. So we're going sort of sideways on the food chain from you. So if you're here, you're Mr. X in the middle, going up with parents and grandparents, going down with kids and grandkids, those are all disqualified. But if you want to go over to your brother over here, and you want to go over to your brother's kids with the nieces and nephews, whatever, or cousins of, your parents' kids or whatever, yeah, you can do that. You can do these transactions with it. So again, know who you're dealing with from the IRA's perspective, because this list will get you into trouble and this list won't. Okay, so look at now some of the missed opportunities that we have. Depreciation. This is a big one because really, I mean, who wants to sit there and read about depreciation, right? I mean, what a boring topic. Oh my God. But you need to understand it from the perspective of owning your rental property. Now, these are the lifetime amounts that you can depreciate different things on. So if you buy a residential property, you're going to take your purchase price and you're going to back out the value of land. Notice we can't depreciate land. So you figure out what the land value was, subtract it out, and whatever the number is that's left over, you divide that by 27 and a half. And that's going to give you your annual depreciation rate. And if it's commercial, we go up to 39 years. So let's say we buy a property for 200,000, 50,000 is the land. So we say the building is 150,000. We then divide that by 27 and a half, and we get whatever 150,000 divided by 27 and a half is. Say let's 6,000 or whatever it is per year. So in this case, you could cash flow the property neutral, meaning let's say you took in 12,000 and you spent 12,000, but you would get a deduction of $6,000 every single year for 27 and a half years on this residential building. So that's where the taxes come in, where you could be making money or breaking even, but your tax return looks like you're losing money because of we're depreciating this. And think about depreciation too from the building. It's like, yes, it's over time, it is the wear and tear on it. You are wearing it down and depreciating the value of it. But with most rental properties, most of the time we're in a position where the value is going up, right? You bought it for 250 over here. Now it's worth three and a quarter. So that $75,000 that it's gone up has never been taxed. Plus, we're saying that not only is it not going up by 75,000, but it's going down in value because we're depreciating it. So this is where it really comes in as far as the tax game goes. And then I've put two other really common amounts here. The appliances, carpet, personal property is 5 years. Same thing, and then we go to the land improvements. So any sort of landscaping or things like that is 15 years. And these two now qualify for bonus depreciation. And we can certainly start looking at the bonus depreciation effects. But I just want to show you how some of this plays out. And again, using a very, very, very basic example, I'm not sure about the 150 in Denver. That's not going to get you a whole lot. Actually, won't get you anything here. But anyways, this person buys a 150 property. We figure 30,000 is the land value. We can do that through the assessed value or through an appraisal. A lot of different ways we want to do it. But here we are again, 27 and a half years. This is our basis in the property to depreciate it, not to sell it. If we go to sell it, this is our sales basis, but our depreciation basis doesn't include our land. So this is our depreciation. So every month we're getting $363.64 of tax benefits on this particular rental property. Okay. And so if you're not making more than that, works out quite well as far as the taxes go. And this is, we can do straight line. We can do what's called bonus depreciation. We can do what's called a cost segregation analysis, and we can use Section 179. So when we look at all the depreciation that I was looking at before, that's the straight line stuff. But what about if we want to be able to offset, 60% of it under the bonus depreciation, or all of it under 100% under Section 179? Or what if we want to reduce the building to some of its components and use this cost segregation to accelerate the depreciation? In other words, to front load the losses to offset some more taxes, more taxable income. So if we look at the same rental property example here, real quickly, we've got this depreciation basis. Everything stays the same. We've got this 120,000, but we've identified in there $20,000 of property that is personal property. Maybe it's appliances, maybe it's a HVAC, some sort of maybe an air conditioner, or whatever it happens to be. We've identified 20,000 in this. What happens then is that our building basis goes down to 100,000, but this extra 20,000 gets accelerated. And so instead of getting 363 a month, we're getting 581 a month. Again, that's all going to come out on the taxes. And so if you don't understand the depreciation, please get yourself educated on it and understand where it comes from and how you can maximize it for your own rental properties. Because I've seen not only in the depreciation realm, but in all of these other areas where we don't always claim all of our tax deductions. Maybe we miss some because we're not recording it properly. Maybe we don't know we can deduct it. But any expense is going to be deductible if it meets these three things: ordinary, necessary, and reasonable. Is it ordinary that a rental property would have some repairs? Sure. Is it necessary? Of course, to keep it in good rental condition. Is it reasonable? Well, was the amount that you spent reasonable? Well, most likely you were trying to get it for as low as you could, and so the reasonableness doesn't come in a lot of times. But if we just look at this on the rental property deductions, and there's likely other ones that are out there as well. So don't think this is an all-inclusive list. It's not. But I've already mentioned the depreciation, and I'm going to talk a little bit about the repairs. But all of these other ones with the, yeah, we know we can do the taxes and the interest, but yes, can we do HOA? And what about if we got to travel there and drive our car there? And, we got to insure it and we do some equipment rental when my tenant leaves and I've got to wash, do the carpets or whatever it happens to be. And so you start adding all of these things up and you've got to have a system in place to make sure that you don't miss any of these deductions. What if you go to the hardware store and you buy $100 worth of supplies there? Well, maybe 50 of it is for your house, not deductible. The other 50 is for your rental property, is deductible. So let's make sure that we nickel and dime the tax return to death, right? Let's make sure that we go through and we don't leave any deductions on the table. Now, the repairs versus improvements used to be a whole lot worse than it is now. Um, Basically, because we can use some of the bonus depreciation and Section 179 and some of the other tax strategies to be able to limit this. But we want it as taxpayers to be a repair because we can deduct it up front. So if we spend $500, we can deduct $500. If it's an improvement, it must be depreciated. So if the expense adds to the overall useful life of the property, it's probably going to be an improvement and you're going to have to depreciate it. Look at the before and after analysis so that if you look at before and you had this kitchen, you look at it afterwards and you have the same kitchen except for the sink doesn't leak, we have a repair. But if you look at the kitchen before and after, and now we've got all new cabinets or all new countertops or whatever, we've got an improvement there. And again, some years it doesn't matter depending on the bonus depreciation rules, but some years it certainly does. Capital gains planning with the rental properties. I've mentioned that you can move into your rental property and claim it as a personal residence. Okay, so let's say I've lived in this house for 5 years. Have I used it as my home for 2 of the last 5 years prior to I'm going to sell it tomorrow? Yes. And have I owned it? Yes. So I haven't had an entity own it. This is not like a limited partnership owning my house or something. I've owned it, or my living trust has owned it, and I've used it as my primary residence for that. So if I do satisfy both of these rules, I get a $250,000 capital gain exclusion. And if I'm married and I file joint, I double that to $500,000. Okay, so it works out quite well if you can satisfy this. But let's say now that I move out of this house that I've lived in, don't have to worry about the capital gains because my gain was less than $500,000 on the property. And now I move into a rental property and I live in it for 2 years. I can do the same thing. I can claim this tax deduction every 2 years. And so if you are in a situation where you have some really nice rental properties that you may want to move in and live in, you can get this $500,000 exclusion if you're married, you file jointly every couple years. So look at the personal residence deduction, capital gain exclusion, excuse me. You can use that every 2 years. All right, missed opportunity number 5. I've got a couple more here, and then I want to get to your questions. I see there's several questions here. I want to make sure too, if you do have any questions, let's make sure they're related to real estate, okay, and taxes, so we don't get into too many other questions that get off the topic here. This qualified business income, this is a major component. To me, probably the greatest component as far as taxpayer favorability under the Trump tax cuts was this QBI. This QBI, so it's qualified business income, QBI, didn't exist before the tax. I can't say that anymore. Trump tax cuts back several years ago. And the reason it came into play is that the capital gain or the income tax rates on the C corps were 28%. And when Trump cut it down to 21%, at that point, then he had to make some sort of adjustments for the flow through entities. And that's where this 20% QBI deduction comes in. And this deduction is allowed even though you don't actually spend the money. So it's a lot like depreciation. in the sense that it's a paper deduction, but a very real one in the tax realm. So we thought at first, all right, great. Real estate, not really a business. The QBI was set up as an offshoot from the C corporation tax rates. So, yeah, this may not apply to real estate investors. And the IRS came back and said it does. And so the safe harbor provision, if you qualify for these three things, again, we have an and in the middle, so you have to qualify for all three. But if you do, you get a potential 20% tax deduction. So if your net income was 10 grand on your rentals, you may be able to deduct 2,000 and only pay tax on the 8,000. And so what we're looking at here, separate books and records for each rental property, which we need to be doing this anyways. And the same thing with point three, to maintain contemporaneous records. Well, you should be doing this whether you get the QBI or not. You want to be writing down your time. Maybe you qualify for a real estate pro and you've got the proof of that 750 hours. But get into the habit of writing down how much time you spent. What did you do? Who did it? When was it done? What type of work was done? And when you get to the end of the year, if you can add these up for all of your rental properties, 250 hours or more, you qualify. So what sort of time qualifies here? Well, any sort of advertising. I mean, these are all rental services. So you're advertising, you're collecting the rent, you're getting materials, you're operating daily operation or maintenance of the property, negotiating leases, supervision of employees, independent contractors. But this big one down here in box number 9, I guess, over here at the bottom right, these 250 hours don't have to be performed by you. So if you have an employee or agents, or you hire a plumber and they come out and they bill you for 3 hours, well, that's 3 hours out of the 250 that you've got satisfied. The question I get then a lot of times is what doesn't qualify, and it's basically investment or financial activities. So you're looking at management activities from a financial perspective. You're planning long-term capital improvements. You're traveling to and from the real estate, arranging financing, reviewing financial statements, reports on operations. So, what we want to make sure of is that we come out with way more than 250 or 750, depending on which test we're trying to satisfy. So don't come up with 252 hours or 753 hours, because if you get audited and the IRS says, well, we don't think 10 hours qualify, now you're under the 250 and you don't get the QBI, or now you're under the 750 and you don't get to qualify as a real estate pro. So make sure you document this stuff. You've got the burden of proof when it comes to an audit. The IRS doesn't have to prove that you're not entitled to it. The IRS doesn't have to do anything. They just have to say, prove that you're entitled to this real estate deduction. And you have to show the paper or whatever it is to be able to prove that. All right, the last point I want to make before I get to your questions here in about 2 minutes is the Augusta rule, the 14-day rule. There's a lot of different speakers. When I see people talking about taxes, they always like to throw this in because it's a real sexy rule, right? You can rent your house out to your business 14 days a year. You don't have to recognize the income. Oh, it's an incredible deal. And it is, but with limitations. Okay, so the first thing on this is that it has to be a residence. It doesn't have to be your primary one, but we're talking about renting out your home. If you rent out for more than 14 days per year, you owe taxes on all of the income. So if you rent out, let's say, a room in your house here for a full year to a tenant, that's a rental property. And you've got to consider that whatever that bedroom or kitchen space or whatever the space is that you're renting out within your house or your basement, or maybe it's a cottage house or some other house around. Again, you've got to account for all of that. So this 14-day rule is absolute there. Fourth bullet point, there's no income limit to the exemption. So this means that whatever is reasonable can be claimed. This is where I think a lot of people get into trouble with this, the reasonableness of the rent. So they have a husband and wife company, and then they say that they're going to rent their house out for 12 times a year, once a month, let's say for 12 months, and they're going to charge a couple grand for it and claim a $25,000 tax deduction for the year. Well, when the IRS, if the IRS comes and audits you on that, they're going to look at you and they're going to say, well, where did you come up with this 25,000 or 2 grand a month, 24,000, whatever it is? Where did that number come from? And was it even reasonable for you to have to pay to have meetings at all in a case where you have, let's say, an LLC that doesn't require meetings and you don't have other owners? So you're going to want to make sure that you charge a competitive rate. What is the rate in your current market? So my market in Denver here to, let's say, rent out a conference room or a meeting room here in Colorado could be very different to somebody in New York City, or maybe somebody that is in the middle of Montana, not near any big city. So we're going to have different amounts depending on your current market, but reasonableness. Be able to show the IRS, if audited, why you had the meeting, why it was business, why it was necessary to have the meeting, and why the amount that you charged the company was reasonable. Okay, so with that, I want to end my presentation tonight and get to your questions here, bring Don back in a second here, with a few final thoughts. And this is what I mentioned at the very beginning. And I know that, when I had my law firm going and before I got into the semi-retirement phase, I would ask clients these three questions when they came into me and I didn't know anything about them. New client comes in, they want to look at the real estate, or they're getting ready to buy a property. My first question is, what do you want to do with the property? What do you want to do with it? And when do you want to get rid of it? And of course, they're thinking, well, wait a second, I'm coming in here, I haven't even bought the property. And this guy's asking me, well, when do you want to sell it? I don't know. But we have to figure that out before you buy the property. Are you planning on flipping it? Well, we may want to throw that into a C Corp or an LLC taxed as a C Corp, where for most of the time, if you said, well, I want to put my rental property in a C Corp, I would say, no, we don't want the C Corp owning assets. So again, we have to look at, what are you planning on doing with the property, and before you even buy it, or maybe if you have it, what is your tax plan now that you're owning it? Do you have tax deductions? Do you have a tax plan? Are you claiming all the tax deductions that you can? And then how are you going to minimize the impact before you sell the property, right? If you know you're going to pay a lot of tax, you better know that before you sell it so that you can engage in a 1031 exchange or do something that may minimize the taxes, or maybe delay the sale until the next year. So sell it in January, not December, because maybe your 1 year is going to be a lot bigger than the other. So there's a lot of different factors that come into play here. We just want to be sure that you have a plan for your property or each of your properties, if you have multiple properties, because they may be vastly different. One you may be holding forever, one you may be holding just till you get a better offer on it. Another one is a 5-year plan, or 10 years, my kid's going to be in college, so I'll sell it then and use that to pay the tuition, or I'll retire in 15 years and I'm going to sell my rental properties then. So what is your plan? You may, at some point there, deviate from the plan. Situations change, but we want to know what that is up front so that we can make sure that we maximize this and not permit the IRS to take what you have. So anyways, with that, that is the end of my presentation here. But I think we need to bring Don back and go from there as far as any of the questions go, Don.
All right. James is asking, does just having a real estate license make you a real estate professional?
That's a really good question, because I get asked that question all the time. And the answer is no, it doesn't. You've still got to satisfy the more than half of your time requirement and the 750 hours. Now, having your license and that's what you're doing for a living, yeah, you're going to qualify because you're most likely going to work more than 15 hours a week, but you've got to prove it.
Yeah, there's two definitions. One is the world definition. You're a professional. One is for the IRS, and the
Right.
IRS and they're not the same. Yeah. So James, nice try, but no. Do you want to look at this next question? Um,
Okay, I am looking at that. I'm not sure what that is. EBLL?
I don't know what that is. I think he's referring to the jobs. Um, what is it? Oh my gosh.
Yeah, I'm sorry. Whoever wrote that one, if you want to tell me what that one is, I'm just not recognizing the acronym.
Yeah,
So
we're talking the Jobs Cuts and Job
yeah,
Act. Okay,
yeah,
so I understand that, but I don't know what the
yeah. The EBLL is the part that I
EBL.
don't
I
get.
don't know. Okay, how is AGI um,
So your
calculated?
yeah, your adjusted gross income, you basically are taking all of your income that you receive from all of the different sources, and then you get to back out a few different expenses on that, and that comes to an adjustable gross income, adjusted gross income, and then from that you take your itemized deduction or standard deduction to get to your taxable income. So your AGI is going to be considerably higher than your taxable income.
Okay, for real estate pros, 750 hours. It must manage, own rental properties. I think you gave a really good slide of here are the different activities that qualify for that, didn't you? Well,
Yeah, I did. I put that in there for the 750 hours, but you don't have to manage your own property. That's something that people don't really understand. That I have rental properties in different parts of the country that I'd be foolish to try to try to run because I'm in Denver and now we've got a toilet problem in Arizona or something. So I have managers on site, on the location that the rental properties are. So again, the hours you spend managing the property count, but it can be you don't have to have self-management.
Okay, great. Jeff is asking, do those tiers of income for reduced capital gains rates, does that include the capital gain itself?
Yes, it does, Jeff. That's a good question. So yeah, when I put, that if you make less than 94,000 or something, you're in the 0% rate. What happens a lot of times is that let's say that you make 90,000 and you have a $10,000 gain there. The first 4,000 won't be taxed. The next six thousand would be taxed at 15%. So you can get a blended rate of 0 and 15 if you're right on the cusp of where the line is drawn as far as the exclusion goes.
I didn't understand that. Thank you. Brent is asking, can you explain reverse 1031 exchanges?
Yeah, so on a regular 1031 exchange, you have a piece of property that you want to sell, and so you go ahead and sell it, and then you identify one or more replacement properties, and you need to close on those. That's a quote unquote normal or traditional 1031. A reverse 1031 says I'm going to buy the replacement property first. So identify that guy. That's what's triggering it is I really want this property. And then the reverse process says I'm going to sell mine to be able to do the exchange. So you're just flipping around which order are you getting the properties. If you're going to do your property first, it's a traditional 1031. If you're going to get the replacement first, it's a reverse 1031.
But either one, whichever one comes first, you have to use you have to identify you're going to do a 1031 exchange. It can't be an after the fact. Oh yeah, let's do the 1031.
Correct. Yeah, you've got to identify the QI, the qualified intermediary. And again, I can't emphasize this enough. Make sure that they're bonded because they're going to be the people or the company or whatever that's going to hold your money. But yes, you've got to identify the QI no matter whether you do a reverse or a regular 1031.
Perfect. Okay. Can my real estate management company charge a management fee to the rental property?
Yes, not only can they, but they should. So if you've got a management company set up, and let's say you've got 10 rentals, and this guy over here is managing all of them, they should pay a reasonable management fee. And in order for you to get the benefits of your structure, you're gonna need income going in there too. So in a typical structure where the management company may be taxed as a C corp and the rental properties are flow through, usually LLCs, but can be whatever. Um, you're going to get the benefit of the deduction on the personal return. The income gets absorbed at a C corp rate, and then we have planning on the C corp, in this case, the management company, to be able to offset some of the 21% tax rate.
Yeah, yeah, and we use that strategy all the time, but the problem that I see is that people aren't getting, well, first problem, they're not getting enough money into the C corp to make it worthwhile. And the second, or the second, which is kind of reversed, they make the management fee unreasonable. What would you normally charge an outside management company? I would, my experience was probably 6 to 10%. You go outside that rate, and you better be have a pretty good reason why. Is that pretty much your experience too, Scott?
I think I totally done. I mean, I think you have to be commercially reasonable with the market that you're in. And I think 6 to 10%, that seems to be kind of the range. And if you're going to go and say, well, we're going to do a 20% management fee, then you better show that that management company is doing services that are well beyond what a typical management company would do. So keep that reasonable, because when you do that, if you have, if you, let's say you have a 10% management fee and you've got 2,500 coming in, so you have a $250 a month management fee. What's the IRS going to say if they audit you? I think that's something that I look at since I used to work there, right? I mean, I can say, well, if I'm at the IRS and I got to go in front of the tax court, and I'm going to say, well, $250 a month is unreasonable when we have comps that say that that's what everybody else is charging. So keep it reasonable within the geographic locale that the rental property is located.
Okay, Christy is asking, what happens to depreciation if you convert the rental property to a personal residence?
You're still, and this, it's a very valid point, is you're still going to need to recapture the depreciation when you sell it. So my example of me moving into a rental property, living there for more than 2 years, using it as my personal residence, is that going to be a tax-free sale? No, because I'm going to have some depreciation recapture. But if I don't do that, all of the capital gains are going to be taxable. I'm not going to get that 250,000 or 500,000 exclusion.
Okay, so what if it still falls? Let's say I've got a $50,000 recapture depreciation, but when I'm still eligible for the $250,000 if I'm single and 500,000. So if it falls within that, then do I pay? Do I have any recapture depreciation? They
You
offset
do.
each other. Is that right?
No, you still would have some depreciation recapture there because they're two different things. So the capital
Okay.
gains and the depreciation recapture are different. They're at different tax rates. I want to say depreciation recapture is 25%. It could be 28%. But anyways, it's slightly higher than your capital gains, even at the highest long-term capital gain rate. So yeah, you do have to kind of compute the capital gains without respect to the depreciation recapture because they're going to be two different items at the sale.
Christy, I hope those that answers your questions. Really good questions. Thank you for
Yeah,
those.
yeah. The depreciation recapture is something that I've had so many people over the years say, well, depreciate, I don't want to have to recapture it, so I just won't claim it. And it's like, well, that's okay. You can do that. But the tax code says depreciation claimed or claimable. So think about this. So you don't claim depreciation, and let's say it was 10 years at 4 grand. So now you got $40,000 of depreciation you didn't claim. You're going to have to recapture that when you close, whether you claim it or not. So the IRS requires you, in effect, to claim depreciation. So it's one of those where I like it because it's an upfront tax benefit and we can offset other income today and worry about the tax consequences tomorrow. Of course, tomorrow comes and then we got to deal with it.
Okay. John is asking, can a married couple claim two different residences if they live in different states? What if they're
Sure.
filing joint separately? Do they
Yeah,
or joint
yeah.
singly or what? How do you?
Well, you could do that. I mean, for purposes of the IRS, it wouldn't make any difference. So let's say that I'm married, I'm in Denver, and my wife lives in Salt Lake City. And so, from a IRS perspective, we file a joint tax return. All of her income from Utah and all of mine from Colorado are going to get reported on there. Where it makes a difference is that for the states, I would file a residency in Colorado and she would file one in Utah. So we may have differences depending on the different tax rates between Utah and Colorado, the different amounts of income that my wife made relative to myself. But yes, you can do that.
And each one of them would have a $250,000 exclusion. Would you have to be filing married filing separately, or can they do jointly?
They can still file jointly on that. We would
Okay.
just exclude, basically, what would happen is my wife would exclude my income from Colorado on her Utah return, and then I would exclude her Utah income on my Colorado return. Both
Oh,
incomes would be included for purposes of the IRS. So, like I said, they don't care where you live as long as you're reporting the income.
okay. Lisa, as far as the personal residence exclusion, if I move a rental home, I was under the impression that I had to prorate the years. If I own the property for 10 years, then move it into it for two, then I can only pro with the capital gain, 2 of 12 for the capital gain. So if the gain is $400,000, can I only exclude 400,000 times 16?
Yeah, I see where we're going on this question. Fortunately, that's not what the law is. So we don't have to worry about any ownership periods there as far as the exclusion goes. The only exclusions that we're really concerned with are the ownership and use test, right? That I owned it for at least 2 of the 5 years before the sale, and I used it as my primary residence, my principal residence, for 2 out of the 5 years before the sale. And if we satisfy both of those, we can exclude the capital gain up to 250,000, or in this case, 500,000 if it sounds like this person might be married. Just remember, it doesn't include the depreciation recapture, but it does. We don't have to worry about any prorations.
Okay. Lisa, we need to elect you to Congress because I like the way you're thinking. Okay. Explain double taxation for C corporations.
Actually, I'm not sure if I want to elect Lisa to Congress because Lisa, I think, was saying there that we don't get the full exclusion, if I
Oh,
read that
okay.
right. So
Okay.
I'm not going to vote for Lisa now because. So what's a double taxation issue for C corps? Well, a lot of accountants that don't understand asset protection and don't understand some of the structuring don't necessarily like C corps because you can't get the money out as easily as you can in an S corp. And where double taxation comes in is that the C corp reports the income. So let's say it reports $1,000 of income, and so it pays tax on that, and then it declares a dividend to you, and you pay tax on that same amount of income. So let's say we have $1,000 comes in, corporation pays 21%, so it has a $210 tax bill, and of the $790 that's left, it pays you out a dividend. Well, that $790 has already been taxed at the corporate level, and now it's going to be taxed at the shareholder level, making it a double taxation issue. So you need to be very careful about that.
Okay. And we our open tax questions keep growing and growing. We started out with four or five, and so Scott, you're doing a great job. But there's also a limit to Scott's time tonight, and so we're going to end at the top of the hour, and we're going to do as much as we can. But keep in mind the 3 day summit is next week, and we'll have Amanda Winalda, we'll have Toby Mathis, we'll have Clint Coons, and their staff to be able to answer questions. So if we can't get everything answered tonight, um, make sure you're at the 3 day summit. Okay, so we got Abraham's question done. Can I use the loss for my rental property to offset ordinary income for my W-2 job?
I think I've answered that one, but again, that's that $100,000 amount. We'll do like a rapid round here, Don. We got
Okay,
10 minutes, and we'll do that. So yeah, if you're making under 100,000, yes. If you make between 100 and 150, You've got that $25,000 limitation. And if your W-2 is over 150,000 a year, the answer is no, unless you or a spouse qualifies as a real estate pro.
Okay. You want to take the next one? Oh,
Okay, so
now I
that,
don't
yes, I
remember.
see now that, so
There's
the
the
EBLL
acronym, but I
was,
don't remember the question now.
I don't either. The excess business loss limitations do come into play as far as the QBI. And I don't remember the exact question, but the real estate activities are blended with other K1s and other activities that would be subject to QBI. And when you get into this EBLL, the excess business loss limitations, it doesn't allow you to offset all of your losses against other income. So the real estate does factor into the excess business losses. And again, I'm not sure that was the question, so I apologize if I totally was political there and didn't even answer your question. But I believe
He was
that's where
he
we
was
were
talking
going.
about the Jobs Cut Act
Yes.
as well, and
Yes,
so
and that's where the EBLL didn't exist before the Tax Cut and Jobs Act. So that didn't exist until the qualified business income came in, and then I think they were looking at it like, well, okay, what if our QBI then ends up being this big negative amount? And what happens if you blend positives and negatives? You know, I have a K1 that shows $1 million of income, and this one shows $500,000 of losses. How do you deal with that? And what happens if there's overall losses? So that's where this EBLL comes in.
okay. I'm not sure about Corey's question. I don't know. Mo number 4, personal
Mo number
residence.
4 was the missed opportunity number 4, personal
Oh yes,
residence.
okay.
So it says, does this apply if they are 5-unit apartments and I reside in one of the units? Yes, you can do that, but it won't apply to the 4 units that you're renting. Okay, so the personal residence would only be your 1-unit apartment. The other 4 are rentals, and the 250 or 500,000 doesn't apply. So if you sold that fiveplex, you would have to then allocate it based on square footage or some other way. How much was your personal residence in the sale, and how much was the 4 other units?
Great. Is Social Security income counted passive or active?
It's neither. It's ordinary. So, active income means it's subject to self-employment tax. Passive income means it's not. Ordinary income can be either one, and Social Security then would fall into that. So it's not considered to be passive income for purposes of offsetting passive losses.
It's a
Oh,
tweener.
yeah, it is kind of, yes.
Okay.
And there's a follow-up there. I just don't have the time to be a tax expert. Boy, man, I said that so many times. Is there a good software package? I mean, not really on the tax planning. What I've seen a lot of clients do on the tax planning side is that you mentioned Toby Mathis was going to be at the 3-day event, and I
Yes.
strongly encourage everybody to attend the upcoming one, or if you can't make that one, at least the next one. But Toby Mathis is an incredible tax attorney, and he's got a program where they'll punch your return information in, and it picks up all these different possibilities via different algorithms and what have you. But I'm not sure the name of it. I know that's their own program, but you get into like TurboTax or something like that. I mean, it's not a good planning mechanism,
Yep.
I think sometimes you just have to put the money out to get the planning from a professional. And I really think this is probably one area where that may be true.
Especially when you're running multiple businesses and dealing with real estate.
Yeah, I agree. I agree on
Okay.
that.
990T tax returns to report UBIT. Are they
Okay, so
audited
this one,
frequently?
yeah, so the 990Ts, that's a tax return that the IRA would file to report the UBIT. Are they audited very often? No, they're not. I mean, the odds of a 990T audit are way less than 1%, way less than that. Very few auditors even know what a 990T is, to be quite honest with you. They just don't get into the nonprofit realm. It's a completely separate section of the IRS, so that if the IRS is auditing somebody on a nonprofits, it's just a pretty rare event. Pretty rare
Okay.
event there.
Which state LLC is good to hold property? It depends on where the property is and where you live. And we're going to spend a lot of time at this at the 3 day summit. But
Y- I-
sometimes, like, it's a complicated thing. If you're in Texas, that might be a series LLC. If you're in Florida, it might be a land trust. If you're in California with an $800 filing fee, we might use a statutory Wyoming statutory trust. So, uh, anonymous, whoever you are, I it's going to take longer than 5 minutes to answer your question. So come to the summit where we break it down.
I think, yeah, and the same thing is true, Don, for Laura's question, the next one, where is the LLC the best company structure to buy real estate? The answer is maybe.
Yep.
It might be,
Yep.
but again, there is not a one size fits all, and there's hundreds of people on this webinar tonight. There's going to be thousands of people that'll be watching this in the future. We have thousands of potential tax plans, right? I mean, there's not, here's the tax plan if you own rental real estate and everybody can use it. I wish I'd make a lot of money if I could sell that. But there isn't. There just isn't that product
So
out there.
Laura, it's kind of like asking, give me the one move that beats every chess game. Well, there isn't one. The
That's right.
answer, and we're not being evasive, but the answer is it really does depend on so many different factors. Are you flipping? Are you holding? What are you doing with the property? How long are you going to hold? I did so much. Okay. Are you
Yeah,
familiar with
yeah.
Rob's tax code?
No.
Okay. If you rent out your primary house for half the year, can you depreciate the house?
Yes, for half the year. Yep. Anytime you're renting anything out, it's depreciable. Okay, whether it's a room in your house, whether it's the little, two-bedroom apartment over the garage in the back, or whether it's a separate structure, doesn't make any difference. Okay. Always depreciate if you have a rental.
Okay, we're getting down. What exactly is an installment sale? How could this be structured to help a seller of a rental property that was used for 6 years?
Well, an installment sale basically, from a tax perspective, only means that you're getting money over two or more periods of time. So, it could be something as stupid as getting a payment in December for escrow, let's say, or to hold the property, right? And then in January closing, in effect, you have an installment sale because it's over 2 years. But a regular installment sale, you're looking at it saying, I've got $100,000 profit here. If I pay tax on that this year, I'm going to pay 25,000 in tax. But if I only pay $10,000 over 10 years, right, I'm still going to pay this. I'm still going to pay tax on the 100,000. But since it's not all bunched up, I'm going to pay tax at a lower rate. So the installment sale gives you the opportunity to spread out the tax liability.
Good. And students, Ken will put in the chat screen a link to sign up for the 3 day summit, protectwealth.com/live events. And he also put in there a link to the agenda. So if you'd like to see what it is that we're going to be talking every day, heavy tax. I think every speaker we've got is going to be talking taxes in some method or not. Let's take two more questions and then we better go.
Sounds like a
Isabel.
plan.
Okay.
Which one do you want to do here?
Isabel, my son bought a loft. It's a condo with his name in his name,
Okay,
which
so
I don't like. Oh, you can read it.
yeah. So my son buys a loft condo. It's in his name, which I don't like as well. Okay,
Yeah.
Isabel, for sure, I don't like that. I want him to create a trust where this asset and possibly other, like his investment accounts, could be moved to and therefore protected. What are tax consequences of the potential transfer? Well, anytime you transfer real estate, you may or may not have an income tax issue. Do we have a sale here, or is it such as putting title from my son's name into an LLC, which you wouldn't have an income tax issue? But you always have to look at local issues. Do you have any transfer taxes? Do you have anything else? Because sometimes, I don't know about your experience, Don, but mine, I mean, I've seen some of the transfer taxes be 1 or 2% of the sales price or the market value. And if this asset's worth $1 million, you could get a $10,000 or $20,000 transfer tax fee on that. But
So
otherwise, I mean, I think typically when you move an asset out of your name into a trust is not going to be a taxable event for purposes of the IRS.
And if it's a revocable trust, like a revocable living trust, there's no asset protection to it. But I agree with Scott. If you're in Florida, they call that transfer fee a stamp tax.
Mm-hmm.
And sometimes there's a mortgage tax. If there's a mortgage on the property, they're assessing the value based on the mortgage that still exists. And so work with us. And again, we're going to cover all of this at the 3-day summit. I'm going to show you charts where the states that have mortgage taxes and the chart showing which ones have real estate taxes. And Clint's going to go over this in great detail. Pennsylvania, we use sleeper deeds, and Tennessee, it, Isabel, it really depends. Let's do one more question, and then we have to go and send Scott on his merry way and defer everything else to the summit. Let's pick Laura. We've been using straight line depreciation since one of our properties was acquired in 2020. May we at this point change to a higher depreciation method?
So that's a real good question there. Anytime you want to change your accounting method, and a change of depreciation is considered to be a change of accounting method, you've got to get the IRS's agreement to it. So the answer is yes, you can do what you want to do, but the IRS has to agree, and normally they will. What they don't want to see you do is switch back and forth every other year. That's what they're not going to allow you to do. So I've had situations where, we didn't take the cost segregation depreciation when we bought the property 3 years ago. Can we amend our return? Well, maybe we can, maybe we can't, depending on the timing. So if we can't amend the return and make that change there, then we have to request the accounting change. And again, I would do that if it's going to be beneficial to you, because you really have nothing to lose. I mean, if the IRS says no, you're in no worse position than if you didn't do it to begin with. So definitely ask for it there.
And even if she's doing straight line depreciation, she could still do cost segregation, couldn't she?
That's right. That's right. You could still do that. So that's always going to be available to you. Obviously, we want to get the maximum depreciation as soon as possible. So we'd want to do that right up front if we could. But doing it late is better than not doing it at all.
That's right. And DC, I read your question, and the answer is absolutely. Um, I- if I've got a rental property down in Florida, my the management fee at a Disneyland resort is going to be 40% to manage my Airbnb. So I mean, if they're going to come in and every day and change the towels and the sheets and scrub the floors, that's a totally different management fee than a long-term rental. So with
Yeah,
that,
Don, I think, Don, we need to look at that too. I mean, that there's completely different issues here for short-term rentals versus long-term. In the short term, if you're looking at 7 days or less as a typical rental period, the rules that we have on rental properties, there's a whole nother set of rules that go into the VRBO, Airbnb realm, and there where you may not have a rental property there. You probably have a business at that point, and that may be a good thing as well. So, Don, if I could just, leave on just one note here, I'm not going to be at this 3-day event. I would strongly encourage everybody to attend, because, again, the tax stuff that Toby Mathis is going to talk about will absolutely be worth it. But like you mentioned, taxes are part of all the presentations, as far as if you're doing asset protection like Clint does, and Clint doesn't have any clue about taxes. I mean, he would be a totally ineffective attorney, right? So
yep.
so he has to have a really strong background in that, just to be able to understand that, if we put Don into a C corp, what's that going to do to his tax plan? Is that going to screw it up, or is that going to make it that much stronger? So again, there's not a one size fits all, and it's up to everybody that was on this presentation tonight, or reading about it or hearing it in the future, to understand that you've got to do this yourself. You've got to get somebody that knows this stuff, that can put a plan in place for you so that it works for you, not anybody else. So, with that, Don, thank you so much for having me on tonight. Everybody, thank you for your time tonight. And again, encourage you strongly, attend the 3-day summit coming up. It's well worth your time.
Thank you, Scott. I so appreciate it, and we really do. It will be well worth your time. Never had somebody go, well, what a waste of time. It's
Mhm.
always like, wow, it was so much information packed into that. Can we reattend? And if you haven't attended for a little while, come back and see what we're doing because everything, well, not everything, most everything changes. And asset protection changes as often as the tax code and how we're doing things. Thank you for Scott. So appreciate your expertise and your really good explanations. Thank you for that. Students, thank you for being on. Have a great evening, and we'll see you at the summit. Thanks. Good night.